Advice 5. Be unchanging amidst change. People often want to buy a large number of stocks but are unwilling to patiently wait for a truly worthwhile investment in a good company. Constantly buying and selling stocks is not a wise approach. Instead, our consistent investment style is to remain steadfast. Investors often lack the patience to wait for success to unfold. Instead, they frequently become impatient, thinking that switching to another stock might be better or losing confidence in their current holdings. Consequently, they engage in daily trading, hoping to profit from market fluctuations. Perhaps they've heard enough jokes about waiting for windfall gains, so they never practiced patience themselves. Warren Buffett's approach, however, is quite the opposite. Once he buys a stock he believes in, most of his subsequent work involves quietly watching it appreciate over time. If you lack patience, you may regret your impulsive actions in many cases. One day, a new manager was assigned to a department. Rumor had it that this manager was highly capable and would revamp the business. People speculated and even prepared to report daily updates on the anticipated changes. However, after a month, the expected storm had not materialized. 2 months passed, and even the enthusiastic reporters lost interest in their exclusive news. 3 months later, the troublemakers who were initially nervous became more active than ever, seemingly emboldened. Now, everyone agrees that the new manager is a kind-hearted person. Although the previous manager was a paper tiger, the new one doesn't even resemble a paper tiger. The rumors exaggerated their abilities. After 4 months, the new manager changed their polite demeanor and began to assert authority. Troublemakers were dismissed, while those who diligently performed their duties were promoted, a classic case of mediocre down, capable up. The transformation was remarkable compared to the manager 4 months prior. At a year-end celebration, the new manager raised their glass and said, "I'm sure you've all been puzzled by my performance since taking office and the subsequent sweeping changes. Let me share a story that will clarify things for you. I have a friend who bought a house with a backyard 2 years ago. Upon moving in, he immediately started a major renovation in the backyard. He cleared out any plants he deemed weeds and replaced them with new flowers. One day, the previous homeowner visited, and my friend proudly invited them to see the transformed backyard. To his surprise, the valuable peonies were missing. It turned out he had mistaken the peonies for weeds and cut them down. Later, he bought another house with an even more chaotic yard. However, this time, he refrained from making any changes. Sure enough, what he thought were dead trees in winter blossomed beautifully in spring. What he considered weeds in spring turned out to be vibrant flowers in summer. And the seemingly dormant small trees burst into colorful foliage in autumn. Only by patiently observing did he recognize which plants were useless and needed removal, preserving the valuable ones. So, here's to each of you. If this office were a garden, you'd be the precious trees. Precious trees don't bloom and bear fruit year-round. Their true value becomes evident only through long-term observation. Don't worry about short-term price fluctuations, Warren Buffett advises. His theory is that as long as a company has intrinsic value, it will eventually shine. Much like gold always glimmers, it's just a matter of time. The key to making money often lies not in how you think, but in whether you can sit still. Section 1. 守株待兔 is an ancient Chinese idiom that describes those who wait passively for opportunities without taking proactive action. In stock market investing, Warren Buffett is famous for his 守株待兔 strategy. Here are the key principles behind his approach. E. Patience and waiting. Buffett believes that 99% of the time is spent waiting, and only 1% is for taking action. He waits for truly worthwhile investment opportunities and then invests heavily in them. Stocks like Coca-Cola, American Express, and Wells Fargo are long-term holdings in his portfolio. R. Choosing excellent companies. Buffett focuses on outstanding companies, especially those with strong competitive advantages. He prefers to hold their stocks for the long term rather than engage in short-term trading. 3. Safety first. Patience first. Buffett emphasizes safety and patience. He doesn't chase short-term gains but focuses on long-term value appreciation. In summary, Buffett's investment philosophy revolves around the intrinsic value of companies, patiently waiting for suitable opportunities, and avoiding blind speculation. In the stock market, we should learn from the patience of a cheetah rather than the impulsive behavior of a monkey. By understanding a company's intrinsic value and patiently holding onto it, we can succeed in the market. Remember, successful investing sometimes requires restraint and not following every market trend. Additionally, let's calculate an interesting scenario. Suppose we follow Buffett's approach and hold stocks for 8 years. If we trade once a month with transaction costs, including taxes, the static expenses would be substantial. However, the devil often erodes our gains without us realizing it. So, it's essential to choose wisely and patiently hold the right tree, stock, to avoid falling into the trap of 守株待兔. Detailed stock selection methods will be discussed further in the next section. Remember, success in investing sometimes requires doing less and having the discipline to wait for the right opportunities. Section R. Cultivate patience. In addition to possessing accurate analytical skills to identify potentially successful stocks, investors also need to cultivate the virtue of patience. Strong self-confidence, unwavering determination, and persistent effort all manifest as patience. Failing to maintain patience may lead to squandering previous gains, akin to letting a cooked duck fly away right before your eyes, leaving you with regret. Stock prices do not follow a straightforward upward trajectory. Instead, they exhibit a zigzagging pattern with both upward and downward movements. Once you've analyzed the market and placed buy or sell orders, it's crucial to withstand the twists and turns without prematurely concluding that your initial decision was absolutely wrong. Unless there are extraordinary events causing a market crash, patience is essential. Stocks rarely deviate from their intended path. They follow their own course. Avoid vacillating between decisions when trading stocks. Impatience and anxiety are detrimental to capturing lucrative opportunities. Remember to persevere even when you feel you can't endure any longer. Every investor should prepare for unexpected short-term effects on both finances and mental well-being. For instance, during the 1973 to 1974 period, many investors experienced varying degrees of losses in securities investments. However, those who believed in their judgment and persisted saw a resurgence between 1975 and 1976, achieving an average annual return of 15% over 5 years. While corporate success may not always align with stock performance in the short term, they remain intrinsically connected in the long run. This inconsistency is the key to profitability. Patience, combined with investments in successful companies, ultimately yields substantial rewards. Keep in mind that our focus should be on the underlying businesses, not the ever-fluctuating stock prices. Despite market volatility and changing policies, the coordinates of enterprise value remain constant. This concept has two implications. E. Market perspective. Regardless of market highs and lows or policy shifts, one truth remains. Stocks belong not only to the market but also to the companies themselves. Market fluctuations cannot alter the intrinsic value of enterprises. Therefore, investors who grasp this core value can mitigate short-term market risks. R. Value philosophy. Enterprise value primarily lies in profitability and growth. Sustained revenue growth characterizes profitability, while growth potential hinges on consistent improvements in profit margins. Although the stock market's current state is unpredictable, holding stocks of fundamentally valuable companies allows investors to weather short-term price fluctuations. This principle embodies adaptability, remaining unchanged in the face of change, where enterprise value remains constant while markets and policies shift. Understanding this reality prevents reactive behavior driven by market trends. Instead, maintain composure, avoid impulsive decisions, and analyze thoroughly before acting. Our goal is ultimate victory, not fleeting success. Price fluctuations shouldn't cause panic. Many investors panic when they see their stock holdings stagnate or decline. They hastily abandon carefully selected companies, forfeiting their hard-earned gains and starting anew from scratch. Additionally, impatient investors react strongly to price fluctuations. Focused on short-term stock price changes, capital movements, popularity shifts, and technical indicators, their emotions fluctuate. They may even doubt their judgment. This price syndrome manifests as tension, confusion, and misguided decisions. When clarity wanes, they mistake correctness for error, and vice versa. Many stock investors have experienced this phenomenon. To avoid such pitfalls, cultivate the ability to remain calm and rational even when emotions run high. Avoid rash decisions. Novice stock investors often fall prey to impulsive decisions. They believe they've stumbled upon a hidden gem without thoroughly analyzing the stock's background or understanding its trends. Before assessing the stock's trajectory, they start calculating potential returns, imagining their money piling up like a small mountain. In this state, they forget about risk, leaving themselves unguarded. Their sole focus becomes the imminent windfall, disregarding potential pitfalls. Such behavior inevitably leads to failure. While seizing opportunities promptly is essential, ensure you're well prepared. Don't rush into action without cooling your head. Analyze the market thoroughly, and only act when you're certain. Otherwise, a single misstep could lead to total losses. Avoid following the footsteps of speculative traders who chase opportunities without considering the risks. Remember, our goal is ultimate victory, not fleeting success. Avoid comparing yourself to others. A common human tendency is to perceive what we possess as inferior to what others have. Our computer isn't as advanced as someone else's, our house isn't as large, or our girlfriend isn't as beautiful. However, our perception doesn't always reflect reality. For instance, while our computer might lack the latest features, it could be more stable. Our house, though smaller, might have a superior location. Our girlfriend, while not conventionally attractive, could be more caring. Comparing ourselves to others often leads to feelings of inadequacy. In the stock market, we must overcome this mindset. Once you've chosen your stocks, hold. Section 3. The concept of 以不变应万变, adapting to change while remaining consistent, in the stock market emphasizes maintaining a steady approach even amidst fluctuations. Here are the key principles. B. Steady investment focus. 星号 stick to areas you understand well. Avoid venturing beyond your expertise, as doing so increases the risk of making poor decisions. 星号 consistently follow established investment methods. Be cautious with unfamiliar approaches, especially derivatives. R. Patience and observation. 星号 after buying, patiently observe price fluctuations without being swayed by short-term volatility. 星号 avoid hasty decisions, stick to your choices and remain calm to achieve long-term success. 3. Mindset matters. 星号 maintain a positive investment mindset. View investing as an art form rather than a gamble. 星号 don't treat the stock market like a slot machine, focus on rational decision-making. Remember, 万变不离其宗, change is inherent, and by understanding the essence behind change, we can navigate the stock market successfully. Can you apply this principle to your investments? Section 4. Holding steady in the military camp. Most stock investors, when holding cash, are eager to invest it in stocks. They feel that keeping cash is wasteful and want to convert it all into money-making stocks immediately. However, it's worth noting that in a letter to stock investors, Warren Buffett mentioned that Berkshire Hathaway didn't spend a single cent of the $43 billion in cash it held throughout the entire year of 2004. In other words, during that year, Buffett didn't find any stocks of fundamentally sound companies at prices low enough to buy. This is not a pleasant situation, Buffett wrote in the letter. Although holding cash without finding worthwhile investment opportunities might be unpleasant, Buffett's approach is prudent. It's better to hold cash than to invest in a bunch of junk stocks just because there's pressure to do so. Otherwise, it could lead to not just unpleasantness but even disastrous outcomes. Buffett's ability to remain steadfast and not be swayed by market temptations lies in his unwavering commitment to investment safety. He firmly adheres to the principle of not making investments unless they meet his criteria. Even if a large amount of cash isn't generating returns in the market, preserving its value is non-negotiable. After all, if the safety of capital is compromised, everything else becomes irrelevant. Cash is the foundation of investing, and without it, even the best opportunities slip through our fingers. Even when the market changes, Buffett advises moving strategically without losing sight of the bigger picture. The story itself shouldn't change unpredictably, otherwise, it's like leading an undisciplined army. In general, during economic downturns or when inflation becomes evident. Investment experts often recommend that investors increase their allocation to safer, more liquid investments. This conservative approach involves maintaining fixed, secure returns while observing market developments and waiting for the right moment to act. Conversely, during economic recovery, investors can selectively increase exposure to higher-yielding investments. Being patient and observant doesn't mean passivity. From an individual stock perspective, investors should grasp the underlying dynamics of the companies behind the stocks. Changes in business strategy can significantly impact stock performance. Analyzing how shifts in corporate strategies affect the stock market is crucial. Only by thoroughly understanding these changes can investors confidently navigate the market and maintain stability, avoiding distractions from irrelevant fluctuations. Remember, safety in investing comes first, and strategic moves should never compromise it. Section 5. Practical analysis. Even if I had special insider information about the next 2 years of monetary policy, I wouldn't change a single thing about my approach, says Warren Buffett, the renowned oracle of Omaha. Buffett's foresight extends beyond short-term market fluctuations or even the next 2 years. That's what sets investment masters apart. Investors shouldn't engage in brutal battles with the market like speculators. Instead, they should focus on the long term, aiming for strategic advantages that lead to ultimate victory. Buffett, often hailed as the stock market sage, surprisingly remained inactive in stock investments for 2 consecutive years. This lack of action significantly impacted Berkshire Hathaway's performance. The company's earnings report for last year revealed a 10% decline in net profit, from nearly $8.2 billion in 2002 to $7.3 billion. Compared to the overall performance of the U.S. stock market, Buffett's recent investment track record has shown signs of decline. For instance, consider the S&P 500 index. The average book value growth rates of its constituent stocks were 28.7% in 2003 and 10.9% in 2004, both surpassing Berkshire Hathaway's performance. Correspondingly, the company had a substantial cash surplus. By December of last year, its cash reserves had increased from $36 billion in 2003 to $43 billion. Media attention has been keenly focused on Buffett's investment performance. Some outlets speculate that he's lost his touch, suggesting that he won't achieve the remarkable feats of the past. Buffett himself acknowledges that his performance as Berkshire Hathaway's chairman and CEO fell short last year due to the lack of new investment targets, resulting in idle funds. Buffett's fame rests on his ability to discover undervalued publicly traded companies during market downturns and execute acquisitions. He then patiently observes their recovery. This classic investment approach has made him a legend. However, some analysts attribute Buffett's difficulty in finding attractively priced acquisition targets to the unusually active merger market last year, a typical seller's market where opportunities were scarce. Nevertheless, even legends have their off days. As a public idol, Buffett faces scrutiny whenever his performance falters. Yet, he doesn't engage in risky maneuvers to appease public expectations. The market isn't an entertainment arena, it demands respect. Even holding idle cash isn't something ordinary investors can afford. Only a stock market sage can weather its storms. Those who rush into opportunities pay a heavy price for recklessness. We should not only refrain from underestimating the practices of the stock market sage but also earnestly learn from them. The wisdom of seasoned investors is undoubtedly reliable. The key lies in extracting their essence. Looking ahead, achieving ultimate victory requires strategic advantages. Always remember, without a resolute spirit, there can be no lofty aspirations. Without tranquility, there can be no far-reaching achievements. Only with clear and unwavering goals, genuine character, and resilience against loneliness can one calmly observe the ever-changing stock market. I stand firm and unyielding.